Hi, everybody. Going to take a few minutes with you today to talk about the IRS's Fresh Start Program and give you some insights. Pretty much everybody in the world has heard about it because it's been advertised all over the place on the radio, so on and so forth. So you got all the butterflies of spring, circling around here with this Fresh Start Program. We thought maybe we'd give you some real insights as to what the Fresh Start Program is all about. So first of all, the very first insight is it really that fresh?
No.
All right. So when we look at this program, let's see just exactly how fresh it is. So what was the release date of the program?
That release date was
May 21st.
2012.
So, gee, that seems like it's 11 years ago to me.
Absolutely.
Pretty close to 11 years ago right now, okay? Yet, you're going to see that there's all kinds of ads out there that talk about, this Fresh Start Program like it's something brand new.
Right.
Not nearly as new as a lot of these radio ads that lead you to believe. I'm not saying it's not a good program. We'll be happy to tell you about the program, and we certainly make use of it all the time.
Absolutely.
It's just a little different than the perspective a lot of people get of it. So, first of all, some of the misinformation that's out there. And I guess this is the part that kind of gets to me the most is numerous ads read, and what you see on the screen right now, anybody who's watching this, is we are changing lives with the IRS Fresh Start. Apply now before the program expires. Well, let me just highlight that. Okay, apply now. You don't apply for the Fresh Start Program,
right.
But these companies that are being less than forthright with you, I guess, are making it sound like something you got to apply for before it goes away. By the way, you notice that's in quotes? It's in quotes because I clipped that from a website and put it on this screen. Exact words, I didn't change a word of it. The only thing I did was to highlight the word apply because there is no apply for the program. Right. All right? So there's all kinds of misinformation out there and misconceptions of what people think the program is. But I'll tell you what, this Fresh Start, like it's going to expire or whatever else, I got to use a word I keep hearing coming out of Washington. This is malarkey. All right. In simple English, what is the Fresh Start Program? And LG, let's tell them about what the Fresh Start Program actually is.
Actually, the Fresh Start Program is a significant revision of the offer and compromise rules for number one.
Okay, so there are rules for an offer and compromise. It isn't. Many people have a misconception even about offer and compromise. You don't just figure out a dollar amount you want to tell the IRS you'll offer them. It's actually very formulaic.
It is. It is.
You got to go through and figure out what the equity is that the taxpayer has in their assets, then how much income they have, how many expenses they have that are allowable, and it's kind of a formula approach to things.
It's a formula approach, and also, Larry, they have to end up qualifying.
Right, and there's negotiation involved in it as well. But nonetheless, there's a set of rules that it operates under. And what the Fresh Start Program did back in when it was released May 21st of 12 was that it changed a lot of those rules, which we'll cover what those rules are. All right, so making an offering compromise accessible to many more troubled taxpayers. You'll see as we go through this what the changes were and what a significant difference they made. Sometimes it made offers half of what they used to be. I mean, easily. So there are many more taxpayers who are qualified now for an offer that would not have been in the past.
Right.
It ended double counting of things like the income producing assets.
Right.
So if you were, if you had your own little business, and let's say you're a printing business, and you had a printing press.
Yes.
And it was worth $50,000. The IRS would count, if you didn't owe any money on it, IRS would count $50,000 asset there. And they'd say, okay, for offer purposes, we're going to count at least 40 of that. And then they'd turn around and they'd count the amount of income that you were making on
They wanted both.
Well, if you sold the machine, you couldn't get the income. And if you got the income, you couldn't sell the machine.
Right.
So they were actually counting, and the old story goes, they were counting the chicken and the egg. Right? And you couldn't do both. Well, they stopped double counting things as far as income producing assets goes. That made a big difference. And it made sense, obviously. It was realistic. They also dramatically reduced the amount of income counted for an offer and compromise in general. And they added new exclusions for
cash, vehicles, plus student loan help.
cash. How much cash can it exclude?
Oh, wow. You can exclude up to $1,000 cash in your bank account.
Okay.
All right? So that cash exclusion helps a lot.
Okay.
All right?
Anything else any other cash I could exclude?
What other cash can I exclude?
How about a 1 month's worth of living expenses?
Oh my goodness, that's the best one, because when I'm analyzing your allowable expenses, okay, and gauge it against my bank account, not only am I allowed to use exclude $1,000, but whatever my monthly allowable expenses are for living expenses, I get to exclude that as well.
And the concept there is pretty simple. The government even believes that you should have money in reserves for emergencies. And so you should have at least enough money set aside to live on for a month. So they're going to allow you to exclude 1 month's worth of living expenses,
makes sense.
plus the $1,000.
It makes a lot of sense.
So if your monthly living expenses, for the sake of example, say they were $4,000.
Yes.
You take the $4,000 plus the $1,000, you could have $5,000 cash in your bank account, and you wouldn't have to count one penny of that in your offer.
That's huge. That is huge.
Never used to be that way before this program happened.
No.
So, are there material changes in this program? There sure are.
There are, yes.
But they just didn't happen yesterday, like all the ads, like people think.
Not as fresh as they think.
How about vehicles? Okay, we used to have to count all of the equity you had in vehicles. So if you owned a car, and let's say your car is only worth $3,000.
Now you're allowed to exclude up to $3,450, and equity in a vehicle.
So before the program change, if you had a $3,000 car, IRS would make you count 80% of that. Okay, so you'd count $2,400 that would go into your offer amount.
Yes.
All right. Under the new program, you have that $3,000 car, and you can exclude up to $3,400. So you excluded all of the car.
You exclude 100% of that equity now.
If your car was even worth $3,450, you could exclude it.
Yes.
And what if your car happened to be worth $4,450?
Then it's $4,400. Then you only count 80%. Okay, for quick sale value.
So it isn't even the fact that you're going to pay $1,000.
No,
because you're always going to take only 80% of the cost.
Absolutely.
Right. So you could actually have a pretty decent automobile and not be counting much at all in an offer.
That's correct.
And if there's a couple filing the offer, a husband and wife, for example, filing an offer, they can do that $3,450 on each car.
On each car, up to two vehicles.
Yeah. One person can't use all of it against their car.
No.
You can't have one taxpayer, a husband driving the Jaguar and the wife driving the clunker, and you can take all of her money and apply it. You can't do that. They don't allow you to go quite that far. But they have done a lot to reduce the equity in vehicles
that
being
has
counted
enhanced
as
that
well.
provision.
And then they did some other things on student loans.
Yes.
Where they will allow. Now, one thing that's very unfair, in my opinion, on it, personal opinion, is that student loans being paid can be counted as an allowable expense, but only if they're guaranteed by the federal government.
Oh.
So it's like, okay, stick it to everybody else, but you owe us the money. Okay, that's legit. Okay, not really right. So I'm not real sure I like that in the way they did it, but at least it's some student loan that gets counted. Right.
Yes.
So they eased the assets on dissipation of assets. Now, what is dissipation of assets?
Dissipation of assets is when I did have an asset, but I disposed of it in some type of manner and did not use the proceeds to pay my tax or pay to the federal government. They consider that a dissipation.
You had $25,000 in the bank.
Yes.
Okay, and under the rules we described, let's say you could exclude that $5,000 worth.
Yes.
You took the $20,000. You took all $25,000 maybe, and you went to Vegas.
I went to Vegas.
And you said, I'm going to win enough to pay the government that $300,000 I owe them.
Right.
And I'm going to go gamble with this money.
Right.
And then you lost it.
I lost it.
Now what?
Now what? Now when I approach the government, I say, "Oh, government, I don't have the $25,000." The government looks back to determine, "Oh, wait a minute. What happened to the $25,000 you had in your account?" "Well, I did this and I did that." They said, "Wait a minute. You did not. You could have taken that money, LG, and paid the government instead of going to Vegas.
And would have reduced your tax.
Would have reduced your taxes. So, in fact, LG, you dissipated your asset.
And therefore, we're going to pretend it still exists.
Thank you. That's the worst part.
In a way, it's kind of like funny money because it's still gone. But the IRS is not going to give you credit for that. They're going to say, no, you could have paid that toward your debt, and we're still going to count it like
it must be included. Yes.
So, somehow or another, it means we have to know what we're doing when we put together offers to make sure that they qualify and they're doing the right thing with them.
Yes.
And the look-back period you're talking about is they look back and see you used to have that money in your bank account. That's how they know.
They do.
So that's what the look-back's all about. And they also did allow some new cooperation on state taxes. So if you happen to be in a state like New York, or California, or any of the other states, many of the other states who have state income tax, and you happen to owe them too, if you owed, let's say you owed, $100,000 to the let's say you owed $75,000 to the IRS and $25,000 to the state, they would say that, okay, fine, if you can afford to pay $1,000 all together, you can give us 3/4 of it and give the state 1/4 of it, and we'll go along with that.
Right.
Instead of the old rule where they'd say, no, we come first, and you pay us first, and let the state wait.
Right.
Which, of course, didn't make the state very happy with you or with the IRS, but that's what would happen in the past. Well, with the new rules, you can kind of split up what you have to pay.
That's huge too, Larry. That is
it makes
huge.
a big difference for some taxpayers.
It does.
So all of these new rules that we just talked about, does that mean that the IRS is now going to accept your offer?
No, it's not an automatic acceptance. No.
Oh, so not necessarily.
Not necessarily.
But may improve your chances depending upon your circumstances. And a lot of it has to do with what your financial position is.
Yes.
So offers still need to meet many different qualifications for acceptance. So if you talk about the new rules, what are they going to do for taxpayers? We're going to help them not only get qualified, but to make a lower offer amount.
Right.
Many of these new rules lowered considerably how much a taxpayer had to offer, making it available to many more taxpayers.
Absolutely.
Because in the old rules, lots of times people just couldn't pay. No matter what, they could get an offer. They could have saved a lot of money maybe, but they still couldn't pay it because it was too high.
Right.
The offer
was too high. Yes.
So, despite the advertisements airing by some tax problem resolution companies, no one can guarantee an offer will be accepted. That would be promising what someone else will be deciding.
Absolutely.
And you can't do that. You don't know for sure what they're going to decide. When we do them, we look at it, we got a real good idea if an offer is going to be accepted or if it's going to be accepted close to what we're offering. But you can't tell for sure what someone else is going to decide.
Right.
Maybe they're even being unreasonable. You don't know what's going to happen.
Right.
But when you hear someone talk about, oh, they can do it, they got the scoreboard they put up sometimes, like, oh, we've saved all this money for so many people. They can't guarantee what's going to happen.
That's correct.
So anytime you hire someone like us or some professional to help you, the money you're spending on those fees, in fact, could be at risk because you may not get your thing put through. We can't guarantee it'll be done. No. All we can guarantee is we'll do the best job possible.
And even though we don't guarantee, like you said, Larry, we normally we don't submit an offer unless we believe.
That's right.
Based upon our calculations and review that it does in fact qualify.
We can guarantee what we will do.
Yes.
We'll guarantee to do the best job on your offer that we can do.
Absolutely.
And that's what really is important. But guaranteeing what the IRS
what the IRS will do, we can't.
No, we can do everything to assure it. Everything we can to assure it, but it's not going to happen. So working with a qualified professional will increase the likelihood of acceptance. A CPA, enrolled agent, or attorney experienced in tax problem resolution is highly recommended.
Very much so.
It is the best way to go ahead and get your offer done. So let's kind of give a couple of examples here before we wrap this thing up today. So we're going to, tell a couple of typical stories, if you will, here. So as you can see by that little graphic, this one's when somebody headed downhill. We're going to be talking about a failed business, all right? So LG, why don't you go ahead and take that
Absolutely.
one.
Taxpayer owed $100,000 in taxes, penalty and interest from a business he once owned and operated. He has no means to pay this and still provide for his family. Can't do it. The business failed several years ago, and with the OIC program, he was now able to become compliant with his tax obligations, and more importantly, this guy was able to sleep at night.
Right. So he had this old tax problem, was haunting him, wasn't going to go away. They got 10 years to collect. That's a long time to live with this problem, And so the failed business in your past would be something we could still do an offer on that.
Yes, we could.
All right. Another case that's worth talking about is we got a picture of a mom with the baby carriage here. Well, maybe this is the single mom case that we've had.
I think it is.
Yeah. So taxpayer was in debt to the IRS. She owed him $85,000 because of withdrawals from an IRA account that she used to pay her living expenses with, and she was unemployed for an extended period of time actually, and the only job she had been able to secure didn't afford her enough money to pay the IRS and pay her bills.
And pay her, yes.
So she was living kind of hand to mouth. Well, the Fresh Start initiative helped her to get a settlement with the IRS, in other words, an offer in compromise, and she got it done for just $4,000.
Wow.
And now she's fully compliant with her taxes. So she went from owing $85,000 down to $4,000, and she's all up to date.
But she didn't dissipate her assets, Larry?
No, she did not.
Because she used them for?
The money she took out of the IRA account, she could account for. She used it for living expenses. You're right.
Professionals need to know that.
That's right.
That's what we review and ask certain questions.
And we're going to be up on that before the offer is submitted.
Absolutely.
So we know what to answer the IRS when we get there, right? So let's talk about one more here. We got the hammock between the palm trees here.
Right.
So this is probably the case of the retired worker.
Right.
So LG, tell them about the retired worker.
Never a high earner, the taxpayer had too little withholdings on his wages for many years. Very little withholding. As he started his retirement, the Internal Revenue Service caught up with him, though, which they normally do, to collect. The changes in the Offer and Compromise program allowed him to finally become current and back on the right side of the government, even though he had underwithheld his taxes for you. That's the whole purpose of the Offer program, Larry, as you stated earlier.
Yep.
Second chance.
Gets them back on track.
Gets them back on track.
Yep.
It can happen.
Turns them into a compliant taxpayer. And
right.
And by the way, it's good for the IRS, too, because these people were never going to be able to pay it. So they might as well make the settlement with them and let the taxpayer start filing their tax return and paying their taxes currently.
That's right.
So going forward, things are better for everybody.
Better for everybody. Absolutely.
So that's what the Offer program is all about. That's what it's supposed to do. That's what its intent is. So what else has been, in the IRS, what else has been freshened, if you will? Well, they've got more flexible payment options than they've had in the past. Ways to pay them have been made easier. They have things like partial pay installment agreements.
Yes.
Making it easier just to make payment, and sometimes even allowing people to pay a small dollar amount for a period of time and then raise it later on when they can afford to, too. How about easing the lien withdrawal rules?
They've eased the lien withdrawal rules, and sometimes they even withdraw a lien if you enter into a certain type of agreement, even before you full pay the tax.
That's right.
So they've eased these rules regarding the lien, which may prevent you from borrowing.
And the rules that are still there to do that withdrawal that you were talking about aren't too difficult. You got to let them take the money directly out of a bank account. You got to do it for 3 months.
Right.
And it only goes up to offers of a certain dollar amount.
A certain dollar amount.
But the bottom line of it is they've still made it easier for a lot of people. So they are trying to get some things turned around here. They've expanded the criteria for small business payment plans. The small business could actually end up maybe owing some payroll taxes or taxes on the business, and they've got payment plans that actually are designed to help them as well.
Yes.
Some additional financial analysis flexibility. Within the IRS, they have discretion as to what they can accept as being allowable expenses, so on and so forth, and they have afforded their examiner people more flexibility in doing that, so they can work with you better. And the terms in the offering compromise are more flexible, although they've all got to be done within 2 years. An offer and compromise, you can't be doing it for more than 2 years. So if you're going to make payment, if you're going to use the payment plan option under an offer, it's one of two options, you've got to still have it done within 2 years.
2 years, yes.
So, but the terms are still way more flexible than what they were before as far as the amount you pay. And modified lien filing. They've actually modified and changed the rules as to lien filing. They don't always file a lien. There are times when you can have them not file a lien with good enough cause. For example, offering a 2261, if you offer a collateral agreement, something like that. All those things can get into it. It's all stuff that a professional should know how to do. Can you always avoid having a lien filed? No.
No.
Typically, a lien is going to be filed.
Right.
But there are times when, under certain circumstances, we can get that done too. So it depends on every situation. So
yes.
We can't obviously detail all of them here.
No.
But I think, it's just important to let you know what some of these things are. And I really, more than anything else, thought we ought to clarify this Fresh Start Program.
Oh, yes.
It's not something that started yesterday.
No.
It's not something that's expiring. There's no expiration date on it now. In fact, it's undergone several changes during the years since it started.
Great improvements.
Yeah, and improvements, many of them, right. So if we could be of any help to you, you can certainly find us by going to irsdistress.com, contacting our office. I hope all of this information was useful to you. So as we leave here, I think I'd like to tell you that, I'm Larry Lawler.
I'm
This is
LG
Brooks.
Yes.
And, we are qualified to represent before the IRS as CPA, enrolled agents, certified tax resolution specialists, and so on. And all the members of our firm, Lawler and Witkowski, are in fact licensed individuals.
Yes.
We operate out of Western New York, but we work all over the country.
All over the country.
And there's a book that we have available that you can get by clicking the link below, and we also offer free consults.
Consultation. That's
So
huge.
other than that, have a great day, everybody, and we'll see you on the next video.